well, we used to have 18% mortgage rates. It's like, you got to do the math. Going from 2, 3, 4, 5, 6, 7 is like going from, 5, 6, 7, 8 up to like 18.
If you are not getting educated about current real estate market conditions, whether you're in finance, mortgages, you're an accountant, you're an attorney, or obviously a real estate agent, you're doing yourself and your client base a disservice. This is the Knowledge Brokers Podcast, and we've got Byron Lazine here, Lisa Chinatti, myself, I'm Tom Toole, but more importantly, we've got Lance Lambert here, the editorial director of Fortune Education. He also writes a weekly Fortune Analytics newsletter. Lance, we are super excited to have you come on. We talk about you all the time on the show. Thank you for making the time.
Yeah, thanks for having me. And that's actually my old title. I'm the real estate editor now for Fortune.
You better tell Fortune to update their website, because that's where I read that from. So that would my bad.
I mean, actually, that photo's from like when I was like 22 or 23. So that's, I need that updated too.
Lance, you do the old realtor trick where you have like a photo from 10 years ago.
Way back. Yeah, exactly.
This is what agents do. then the consumer gets to the property like, is this you? Looking good on the updated version as well, Lance. Yeah, we're all huge fans of your work and excited to have this conversation with you.
Yeah, I'm excited to be on too. And there's just so much going on in the market and so many different things across the country. And it's just a really interesting time for real estate and housing.
All right. So before Tom gives you the first question, this is one that you want to share. This is state of the housing market as it sits here today, beginning of August 2023. Go ahead, Tom. Take it away.
Sure. So, we're constantly talking about what consumers are seeing, the pain points for consumers, the uncertainty and the volatility that we've seen in the market this year. And before the show, we were talking about interest rates, and we're seeing 7.25 is where rates have been bouncing around the past 30 days. And the question I've got for you is that there's all these major organizations, the Mortgage Bankers Association, Goldman Sachs, Morningstar, they're telling us rates are going to come down and maybe even like 5.9 by the end of the year. And from my perspective, I'd love to see it. I think it'd be great for the market. I don't know how we get there, and would love your take on these predictions. Number one, what you think is going to happen, and what events would need to occur, or what things would need to happen in the market to get to a high 5, low 6, 30-year fixed rate.
Yeah, and I think to zoom out, if you go all the way back to the start of COVID, March 2020, forecast from that point to now, they don't have a great track record. And this is on house prices, this is on mortgage rates. We have seen so many big shifts in the market that are outside of historic norms. Mortgage rates going under 3%, down to the 2s. House prices overheating at a level that actually surpassed at its height in terms of velocity upward, surpassed the housing bubble and surpassed the 70s boom. 2021 saw the biggest jump in home price appreciation ever, 21%. And so I think that's my way of saying take everything with a grain of salt, because we've been in such an uncertain environment with the pandemic shocks that have been on the supply side and the demand side. And now as we're kind of unwinding from those shocks and seeing how the economy responds, I do think there's a lot of uncertainty. The labor market is very, very strong, and that works against the real estate industry, really. It's keeping upward pressure on the rates, keeping us higher for longer. But it's a question of when will the labor market start to ease up more? And is that coming? There's some that are like, what? The Fed no longer has as much power through its, tools in its toolkit, monetary policy. So many people have fixed interest rates, including businesses and homeowners, that when the Fed jacks up rates, it doesn't have an impact on the economy as much as it used to. That's one theory. I'm a little more in the camp that I think that there was a pandemic effects that happened on housing, and we all know those ones, but there was also effects on the labor market. There was a lot of retirements that happened right off the get-go. People's, they could work from home, and so they eased into part-time retirement. The financial side of the market asset prices went so high so quickly that some of the people who were close to retirement were like, you know what, this might be a good time to do it. So retirements went up a lot. Immigration went down. We also had, more people pulled into the workforce because they could now work remote, which started to happen later on. So what happened is we had a very tightening of the labor market that made it very hot, and that hasn't quite let up. And so kind of in the same way that housing has overheated, the labor market has also kind of overheated in a way. And it's a question of how much longer will that go on. And when you look at the forecast, they're all over the place. You do have the morning stars that think, in 3-4 years we'll be at 4%, which would be a dramatically shifted economy. It would cool down quite a bit. It would probably have to be through a recession and probably a hard landing recession to get there. And then you have other ones like Goldman Sachs, who they think that the 10-year yield is going to stay in the 3.7s, 3.8s, not for 1 year, not for 2 years, not for 3-4 years is how long they think plus. And so in that environment, mortgage rates are staying higher for longer. And if you look at their forecast, the reason is they think the unemployment rate is going to stay under 4, and that while inflation isn't going to run again, it's going to hover, it's going to slowly inch from 3 to 2 and kind of bounce around there. And, an unemployment, a CPI that year over year that stays over 2 isn't necessarily going to be the mechanism that brings down mortgage rates as much as the industry has hoped. And we've seen that already this year as we've kind of drifted up, gotten closer to 3, and we're going to go under 3 pretty soon.
Goldman Sachs, despite where they have the 10-year, they have that gap closing a little bit. So they still have the 30-year on their, next couple of year projection coming down closer to 6 and under.
Exactly. Yeah. So a lot of the places, including Moody's Analytics, think that the 10-year is probably going to stay pretty firm, maybe even inch up a little more potentially, depending on how things kind of crumble from here. But they think that the spread over time will ease up. And so mortgage rates could come down a bit, even if the 10-year were to stay here or even drift maybe a little higher. And it was interesting to see over the past 2 weeks, the 10-year has went on a little bit of a run, and mortgage rates haven't followed suit at the same pace. And so yesterday we got the lowest spread reading in, I think, 4 or 5 months at 302 basis points for Mortgage News Daily. So I think that's interesting. Mark Zandi, Moody's Analytics chief economist, when we chat, where he's been with mortgage rates, and he hasn't changed his view much in like 11 months, is that back, 11 months ago, the last time he revised his mortgage rate forecast, he had it 6.5 for this year, which is pretty close to what it's probably going to average to, 6 for next year, and then 5.5 for 2025. And most of that drop coming through the spread coming down. But his view that was unique on the spread was that it wasn't that interest rates from the Fed, the short-term rates, didn't need to just top out. In his view, they need to actually start cutting the rates and kind of moving away from a restrictive environment on the quantitative side. Which that's a little different than some of the other theories out there. Some people think, once the Fed has kind of reached, that top rate, that terminal rate, that then we would start to ease up on the spread. But that's not Zandi's view.
Zandi views once we start actually cutting the rate, the spread will, I guess, more normalize in historic trends.
Yeah, exactly. In a slow way down. Yeah.
And obviously the rates have, you've coined it the lock-in effect. I went with the Cold War theory of real estate where it just freezes the market. I started using that term probably 18 months ago. Logan Mohtashami recently on CNBC, I think earlier this week, disagreed. And obviously, Logan over at Housing, he disagreed that there's this lock-in effect or this freezing of the market. He says it's just simply an affordability issue. I sit on the other side of that. And I think he's saying the same thing. He might just be being a little bit of a contrarian there. But explain your view on, you've written about it, calling it the lock-in effect, where people don't want to move because they're protecting this asset that they have of a low interest rate on their home. And Logan's saying they can't afford to move. Where do you stand on the lock-in effect as we sit here now?
Yeah, so my view, and when I do things like this, I like to define it. So lock-in effect to me is the impact that occurs on new listings. And if you look at the data, ever since mortgage rates jumped, almost tripled, we have seen a noticeable decline in new listings across the whole country. And there are no outliers there. Even Austin, which is a market in a correction, new listings there are still down 30% year over year. So we have seen the churn side of the market pull back, because why would you sell your home at this low and then go buy another home at a much higher rate? And the affordability argument purely, and yes, it is because of affordability, but the thing is, house price is kind of, it doesn't benefit you a ton one way or the other once you have a home and have the equity. If you're going to sell in a market and then go buy something new, the price doesn't matter as much, right? It's the rates, in my opinion. And the fact that we have seen such a noticeable shift down on new listings, coinciding with the mortgage rate shock. And so this, I will say this though, in theory, the lock-in effect is felt most acute on the initial shock. Over time, there's acceptance, right? People have more kids, they make more money, life happens. The longer those 7% or 6% or 5%, whatever, stick around, people are like, you know what, this is the new normal, I need to move on with my life, type of thing. And so the impact on new listings, I think, has already occurred. And the hope for the industry is that we're kind of in a grind towards stabilization from here. Like the hit from the lock-in effect has happened. Now, how do we get out of it? And of course, the number one thing that would shift new listings up would be if rates fell down, right? I think that would bring churn back into the market. And that's why everyone who makes money on volume is rooting for rates to go down, because they see it every day that the lock-in effect is real. They know, and they talk to these people who would probably sell their home and go buy something new if the shift from their rate to the elevated rate wasn't as steep as it is right now.
Just to wrap up some of the economy stuff, if we do hit a soft landing, all right, that's the big debate right now. Will Powell, land the plane softly? Is it going to happen? If that does happen and we avoid recession, does the real estate market in particular come roaring back where we see an environment with low rates and transactions going up? What happens specifically to rates, existing home sales? Are builders the big winner? What's your, prediction on, if we hit a soft landing, what happens to housing in the next 12 to 24 months?
Yeah. Well, so I think the thing there is to also bucket it, right? So there's hard landing, recession. There's soft landing, inflation is tamed. We don't have recession, and the Fed eases up on rates. And then there's the third bucket, which is where we are right now, which is no landing, higher for longer. And it's a question of, in that theory, we avoid recession, but which of the other two buckets are we in? Is inflation starting to be a little more sticky, or does the Fed feel like we've actually landed this plane? And so those two latter buckets would, of course, affect the answer there, because if it's the no landing, it's probably more of a depressed housing transaction volume. I think it's the middle bucket that the industry would like, which is soft landing, inflation tamed, Fed starts cutting rates, the affordability aspect of the market improves, transaction volumes go up. Now the interesting question is, putting aside the middle bucket, the soft landing, the sweet spot, which would the industry prefer? The no landing higher for longer, or the hard landing recession, because that last one, that would bring rates down the fastest of all of them, and probably has way more transaction volume than the no landing higher for longer bucket. And then plus, the longer you stay in that higher for longer no landing bucket, your odds of recession are still there because you haven't landed one way or the other still.
Recession also gives probably the highest chance of, getting prices in a more affordable range, certainly, closer to, what the majority of buyers can afford, because those rates come down. But also in a recession, you would envision more people having to sell because if they're losing their job, which could create more inventory. Do you think the recession, because a soft landing, I could see prices going up because of the pent up demand.
Yeah.
Right. So would recession be our only chance at a more affordable existing home sale?
In terms of overall affordability?
Just on price, not overall. Like let's
No.
go price, because I think we all agree rates would be lower, or lower faster, but on price.
Yeah, it's a hard, I think there are some people, CoreLogic, obviously AEI, Housing Center, Zillow, that are like, what, higher for longer is not going to bring down prices. We have already bottomed, is their view. I talked to a lot of other housing economists who, don't hold that view, or at least aren't willing to let themselves hold that view yet. They want to see, obviously, the second half of this year, because there's the potential that seasonality could bite harder both ways, right? So in the beginning of the year, seasonality bit very hard, and we shifted very quickly from that December, January low into the, January, February upswing, right? And that's because existing inventory was just so tight. But what's happened is that upswing that we saw in the first half of the year has only deteriorated housing affordability back to where it was in October and November. These price gains plus mortgage rates inching back up. So it's, as we move into the second half of the year, is it possible that deteriorated affordability, the other side of the market, bites back harder the other way? And that would kind of be like what we saw in the 90s, which is, okay, appreciation in the spring and then blowing it off in the second half of the year. Next year, same thing. And you kind of went through a few years of it. One reason that some people don't think that's going to happen is because appreciation was just so strong in the first half of the year. That would kind of be like the Zillow camp.
If you want to be the knowledge broker in your marketplace, you need BAMX. It is a curated community of on-demand courses like the world-renowned Tom Toole, the best objection handler in the country, showing you how to handle seller and buyer objections on a consistent basis. Canva courses, how to design your own marketing so you can appeal to people on social media through email and look like a professional. And you get a private community with other like-minded folks like you that want to make their business better. Use the code Knowledge Brokers for 10% off. Get BAMX now. Do yourself a favor and go outwork and out-educate your competition.
So I do think that a lot of the models that I look at do believe that the recession, hard landing, is probably the most likely to pull further, although there's some disagreement there. And then if we stay in this higher for longer period, I think it's a little uncertain still how the price side works out. But again, right now what we're seeing is, when I say uncertain, that could mean, going down 3 or 4%, right? Like, is that risk still there? I'm not talking about risk of like something dramatically to the downside right now. Yeah, but it's interesting. And the fact that, the way that some of those Western markets were hit last year, that's something I'm keeping my eye on moving into the second half of the year.
Interesting. Yeah. I tend to agree with the seasonality, taking some of the increases off a bit. Lisa, you want to jump in? What's the top of your mind with Lance?
I think for me, it's really kind of looking at, I think going back to the lock-in effect. And I think my big question is, from your opinion, what's the one thing that's going to change it? Is it tied to rates? Is it tied to seasonality? How do we get out of it?
Yeah. Acceptance and affordability improvements would be. I think those two would be the top two, and the third, which goes back to actually the first and the second, is time. You look at some of the models produced by like Goldman. They don't think that existing is going to get back to pre-pandemic levels until like 2027. So they're a little bearish there because they're higher for longer. But I think you probably need some affordability improvements here.
2027 seems like an awfully long time away to keep going at the low inventory levels that we're at.
And how much do they take into consideration boomer movement? I guess they're probably taking everything in consideration, right?
Well,
Because
these models aren't perfect. I mean, I
Yeah.
doubt that is probably going to happen. One way or the other, something's probably going to be very different by 2027. I mean, and all it takes is the economy cooling down unexpectedly, and that model's out the door, because there is pent up churn out there now building. Like, people want to move, and that's why when you look at these eyeballs on like the builders websites and even like Redfin and Zillow, they're still very high because people are thinking about it. So all it takes is a shift in affordability, and I think some of that pent up churn is coming back.
I think baby boomers are the most protected by the environment that we're in right now because of the wealth that they've accumulated. So if they want to go, sell one home and buy another, or buy a second, whatever they want to do, they can do it as as a buyer and seller demographic. They're not as constrained like millennials or younger home buyers and sellers to the mortgage rate. And I know Ivy Zellman had a report a couple of years ago that she thought in 10 or 15 years, somewhere in that range, we're going to have an inventory problem, meaning, and it's hard to envision right now that we're going to have so much inventory because of boomers exiting out of these homes that it would actually be an issue in places like Florida and other parts of the country where there's a lot of boomers migrating to. But it's also hard for a brand new real estate agent right now to imagine what 2010, 11, 12, and 13 felt like, certainly places in the Northeast where you had to beg another agent to bring you a buyer and get a showing. We're not talking about an offer. You were begging in certain price points in the Northeast for showings because that's how little activity there was. Months of supply were through the roof. Is there an environment where we could ever go back to that? Like Ivy Zellman's projecting out 10 years from basically now, where you see a scenario where the market's completely flipped, which would be mind boggling to new agents.
Yeah, the answer is 100%. And I say that because if you look back at housing cycles, and I don't mean this to say that 100% what she said is going to happen, but 100% an environment 10 years out can be dramatically different, and different in ways that we've never seen before. Like, all of these variables and factors can all be flipped in many different directions. And you just look at like the market that we're in, it is a very, very unique market, historically speaking. Like, this hyper low inventory, the dramatic upswing that we saw in prices, then the rate shock is one of the biggest ones in history. And even though people are like, well, we used to have 18% mortgage rates, it's like, you got to do the math. Going from 2, 3, 4, 5, 6, 7 is like going from 5, 6, 7, 8 up to like 18 in terms of if you do the math. And so I think it's possible that the market could be very different in 10 years, especially if we're going to continue to have any type of overheating that continues to push affordability to the top and we stay there for a long time, that would probably build inventory over time if you stay in that environment.
Interesting. Yeah. And it's hard when you're in it right now, especially for newer agents who haven't been through a different cycle, to even envision it or think that that's possible. They almost think you're telling them a folk tale. When I talk about 2012,
Yeah.
they're like, you just want me to believe it was hard the other way. And it's like almost like you're saying, I used to walk into school in the snow type of thing. But yeah, these markets do change.
Let me give you a crazy stat. So in the second half of last year, that was the second biggest home price correction of the post-World War II era.
Yes.
Think about that for a second.
Wow.
5% drop in 7 months. Now on the back half, now we saw us almost move up. We almost regained it all. But that 7-month period is the second biggest dip in home prices of the post-World War II era. But if you look at the home builder side, completions never really dropped. They kept churning out the homes. And yeah, there was a period where the cancellations rates soared and they had to do affordability adjustments to bring buyers back in. But we didn't have a construction bust. And we've had 6 or so construction busts of the post-World War II era. And all of those caused a recession. Only one of those saw nominal existing home prices crash, which is the crash, the historical anomaly. But then here we had the second biggest dip in nominal prices, but no housing bust. And what that goes to is every cycle is very, very different. And the factors that lead into them are different. And what it is this time we weren't overbuilt like those other construction busts. And the overheating that occurred during the pandemic housing boom pushed builders' margins to the highest in history. And so they were able to just take those margins, spread them into buy down, spread them into some other incentives, spread them into some price cuts, and meet the market again and avoid a bust, which is actually good for the economy and good for anyone who cares about housing supply, is that we were able to get through the biggest part of the rate shock without a construction bust.
It's fascinating. So I want to talk about the Fed a little bit because we've got a kind of a big break here happening between the last meeting and the September meeting. We'll have more data, 2 months of data. We're also entering an election year. And I have a feeling that they're going to kind of change their approach a little bit because that's what happens during elections, right? And this is going to be very hotly contested. Where do you see the Fed going next? Because Byron's been talking about this a lot with the inflation data can be a little faulty because of some of the aged rental numbers that are being used. Barry Sternlight's talked about this. How do you see the next meeting playing out for the Fed? And what do you see their outlook as we move through the end of this year and the beginning of next year? Because they won't really talk about housing much. Byron, it was what, 2 or 3 times they mentioned housing at the post?
Three, total of 3 in an hour. And one of them was a question and answer at the end. And the reporter did a really poor job of following up with what Jerome Powell meant when he said there's a lot of inventory coming online. I think we're all going to assume that it's multifamily. But if I'm that reporter, that's an instant follow-up. But I can't imagine they're probably an expert like Lance. So we'll let Lance explain.
Please.
Yeah, well, I would have loved to actually been there and ask the housing question. And the one that he got into in September, that difficult correction one, I actually wrote that question for the CNN reporter. Sorry, I can't think today. But right now we're in a restrictive monetary stance, and we have seen a steady deceleration in inflation. And they know that there's still more to come in terms of the housing side because there is such a lag. But I think the Fed is looking at a whole host of different things to see if, this improvement in the economy that looks like it's happening could recelerate any types of inflation. And so I think they're watching, and people are pretty divided in terms of like what they could do with this last one. But at the end of the day, one more rate hike or even 2 isn't a huge difference, especially for us, which we're kind of at the long-term rates that kind of look far out. And the bigger question is not, do we have another rate hike, but is how long are we going to stay here? How long is the Fed going to hold this? the stance. That's the really big issue. And then keep in mind that the markets and financial markets, they don't have to wait on the Fed to cut. If they expect it, they can price it in. And so to me, the more interesting thing is less of what the Fed decides, less about in terms of what the Fed's talking about, and more of just like, what are these next 3-4 months with data, labor market data, housing, a whole host of data looking like?
And I think you tweeted it that, I think we're all in the same camp. We're going to assume Powell was talking about all this inventory coming online being from multifamily and apartments that are due to come on at the end of this year. Why are we in such a better place with coming inventory for multifamily and apartments? I have my conspiracies around this, but why are we in such a better place with apartment inventory than we are with helping Americans become homeowners at an affordable rate?
Yeah, so a part of it is that we had the correction for housing in 08, 09, and then we had an overcorrection in 2010, 2011, 2012, and home building levels just got so low that from that point on, we had to play catch up, and we're playing catch up for everything. And the multifamily side was really far behind at the time as millennials were kind of moving into their 20s and 30s, and there just wasn't enough demand for multi. And so we spent all the past decade catching up to it. And that's what this run up is, and multifamily is catching up to that. But now we're already shifting, the millennials shifting from the multifamily stage into more the single family stage, and we're not ready. And so it'll probably be like the same type of thing where it took so long to get all the permits moving. Builders are very conservative after what they went through in the crash. And so, it just takes time.
Are there markets where we are going to just see way too much inventory on apartments?
I think that's probably the case in a short-term period. You think some of the ones in the Southwest, Nashville in particular, some of those markets that built like crazy, you probably do. But I think for the health of the market, that's not a bad thing, having more housing space.
More rent, you think for the health of the market, I guess overall, it's a Band-Aid fix though. If I'm in the market to buy a home and all of a sudden prices come down on rental, it means that I'm extending out another 2 or 3 years my dream of home ownership, and homeowners are 44x more wealthy than renters. Do you want to see more home ownership for Americans, or is it just more about an affordable option?
Oh, in terms of the home ownership rates, I don't necessarily know that's something that, things being good or bad, I don't think about as much. I'm more interested in like where are things headed and where we're moving and what's the reality. But the reality is that housing affordability is historically deteriorated right now for new home buyers. And so things that can ease that part of the market. Affordability is not deteriorated to historic levels for homeowners. Many of them with the fixed rates actually are doing quite fine. Although in some parts of the country, these property taxes and insurance, they're going to bite them in some places that are coming. And the renters aren't necessarily they're not necessarily at some crazy historical level with rents. It's really the new home buyers. And so anything that we could do to improve affordability at that juncture, I think would help out. The rents part and more multifamily doesn't necessarily help there, but it might, like you said, pull back some of the home buyer demand because the economics don't make sense. And that creates easing as active listings could potentially rise.
Yeah, you might see, like Nashville, for example, you might see a competitive environment with all these, new multifamilies where they actually have to offer incentives and deals, and we're seeing rents certainly not accelerate as fast as they were, and some reports have them, down year over year on total rent prices. You mentioned insurance and taxes in there. I'm in agreement. property taxes and insurance are going to impact current homeowners who might be on easy street with their rate right now. Will that actually help inventory?
Maybe. It'd be something to watch. And especially in Florida and along the Gulf, keep an eye on it. And I think anything there that could add stress into the market, insurance, property taxes, these student loan payments coming back, watch those things. Keep an eye on those, because the reason we don't have inventory right now on active listings is because there's not the stress on the homeowner side. And this mortgage rate shock did not trigger any supply coming into the market. Had there been stress on the homeowner side, and those people would have came in, very different story on prices, very different story on prices. And we can see that given the fact that we had some correction on prices even without the supply in the second half of last year. So had that happened and we had more stress, it would have been a bit of a different story. And keep in mind, somebody who's under financial distress selling is very different in terms of housing economics than somebody who isn't selling their home to buy something new because of a higher rate. The latter is supply and demand. They're not selling and they're not buying. The distress side, that's just supply. There's no increased demand that comes with it. Whereas the churn side, the mortgage rate lock-in effect, that's a very different story for real estate economics.
That's a really good point, because I know during the pandemic, I mean, it was a lot of people worried about like this wave of foreclosures and things that were going to happen, but the prices were going up so much, it wasn't really creating a lot of stress because you could still sell your home and get out. So, as we move forward here, I always like to, this show, what we do is we try to cater to real estate agents to get them informed. If you're a real estate agent right now, Lance, where are you going looking for inventory and homes to list? What would be your strategy? I know this might be put you outside your comfort zone a little bit, but this is what knowledge brokers want.
Okay, I'm down to 1% on my computer, so it might die and I might disappear in a second. But
can you plug in?
I don't know where it's at. I've been thinking about it in the back of my head for the past 10 minutes.
Imagine that anxiety.
Because I have a great follow-up question about agents, but go ahead.
Well, do you want to jump to the follow-up question? Because I'm not.
Unless you want to pause and grab the charger.
It's okay. I got to jump in a second anyway.
Okay. No, I mean, it's along the lines of what Tom said. I see you talking to a lot of agents online, on Twitter, for example. And so, yeah, where can they look for inventory, and what, in your opinion, just tracking agents, looking at stories, looking at all the data that you do look at, what's the biggest mistake agents are making right now? There's a lot of, issues coming, DOJ and different things that could impact the real estate agent industry. What's the biggest mistake agents are making right now to put themselves, into their market as the knowledge broker, as the expert?
Yeah, I think sometimes you play ahead, because while this is a lull, this isn't a great period. It's a great time to get market information, knowing the families that would love to list their home once rates come down, who is about to have kids that could be in a situation where they're going to be listing soon, getting a feel on and building connections for future sales and future churn, I think is a great way to spend a lull. And I say that as somebody who works in a profession, media, where we are very cyclical. We go through our down periods. I've been laid off twice. Even great reporters and journalists will go through layoffs and slumps. And so it's always important to, when you're in those periods, or even it's the good times or the bad times, always be playing ahead.
Any hot take on some of the lawsuits surrounding the real estate agent industry, DOJ, some of the stuff going on there?
I'm not following those as closely as I probably should.
Honest answer.
We'll take it. Lance, it's been a pleasure. Thank you so much for your time.
Thank you.
Appreciate chatting with you. Hopefully we can do it again too.
Yeah, I would love to come on again. And sorry about the charger running out. I think it's about